right, guys, it's Doc's Market Minute for Monday, November 16th. This is FXI. This is the China ETF. So while it's not exactly the same as the Shanghai Index, it's pretty close proxy to it. So it's certainly something that we can watch and we can trade, and it's pretty liquid. So of course, what we had was this summer, we had this massive sell-off down here. And when we have moves like this, when it gets too far too fast, what we see is the rubber band will stretch and then snap back to a certain degree. But I've been watching this rebound rally pretty carefully here over the last few weeks, and what I'm seeing is it's kind of running out of steam. And right now we're in a daily downtrend on there. Daily downtrend, which means a weekly pullback. Now what we have to watch for is when the weekly chart bounces back up again. If that forms a lower high, then what we're going to see is, if that fails as a lower high, we're going to see this fill in the triangle very, very quickly. Now, what can we set up ahead of time to take advantage of that? Frankly, if this thing starts moving, you'll never be able to get on board. The implied volatility rises way too high, too quickly, and it's literally impossible to jump on board as this train leaves the station. What can we set up ahead of time that we could take advantage of this potential move moving forward? Now, one thing I like about this, I'm going over to ThinkorSwim Charts here because we've got this neat little gadget. First of all, we can map the implied volatility, which is in the blue, as well as the realized volatility, which is in the pink or the red down here. And we're at a fairly low level right now. The relative implied volatility compared to what we've seen over the past year is about 32 percentile right now. So it's in the lower third, and this is actually an area where we want to be long options and not sell them. All right, here's the option chain for FXI. And what we can do is we can see right off the bat that the expected move for this to December expiration is about 2.8. So our downside target is not very far between now and December expiration. We could actually even go out a little bit further in time to maybe January and give ourselves plenty of time for that move to kick in. And the expected move is about 3.9. So let's just round that off and say that our target is about 4 points below where it's trading today, which is 37.5. So we would set up a target maybe for January for like 33.5 or so. So to do something like that, we could just buy the 33.34 spread here for January, give ourselves plenty of time for this, just buy the vertical 33.34, and this is what I love to see. We've got a $1 wide spread, which is about, we could probably get into this for about $20 per contract. So about a 20-cent debit, 20 bucks per contract. This is ideal for small accounts. This is the way to speculate because we're speculating based on price action. We're speculating based on the edge of implied volatility being low or a relative low being in our favor when we're buying options. And we've given ourselves plenty of time for the trade to work out. So we're not sitting there losing any sleep or buying a long put option for an expensive price and then watching that erode. Buying a spread like this allows us to very tightly control the position size for this due to the granularity of the width of the spread. Now, there's no guarantee that price is going to go down there for the FXI. There's no guarantee that China is going to roll over again, and it may just rally from here. But again, markets are allowed to do whatever they want to do. All we're trying to do is to put ourselves into position to win through probability. That's it for today's Market Minute. Thanks for listening, folks. We'll see you tomorrow.